Warning signs in financial reporting are indicators suggesting that a company's reported financial performance may not accurately reflect its underlying economic condition. The program emphasizes that analysts must remain alert to signals of aggressive accounting, earnings manipulation, or deteriorating reporting quality. Warning signs do not necessarily prove fraud or intentional misconduct, but they highlight areas requiring closer investigation. Identifying these indicators is important because misleading financial statements can distort valuation, risk assessment, and investment decisions. Analysts therefore examine accounting policies, financial ratios, cash flow trends, and disclosure quality carefully to determine whether reported earnings are sustainable and whether management's financial reporting practices faithfully represent economic reality and long-term business performance. One important warning sign involves persistent differences between net income and cash flow from operations. High-quality earnings are generally supported by strong operating cash flow, while weak or declining operating cash flow relative to accounting earnings may indicate aggressive revenue recognition or poor earnings quality. The program notes that persistent earnings growth unsupported by operating cash flow deserves careful scrutiny. Rising accounts receivable, excessive inventory growth, or unusually large accruals may further suggest that reported revenue is not translating into actual cash collection. Analysts therefore compare income statement performance with cash flow trends to determine whether profitability reflects sustainable operational success or accounting-driven earnings expansion. Changes in accounting policies or estimates may also signal potential reporting concerns. Frequent adjustments to depreciation methods, inventory valuation assumptions, useful lives of assets, or revenue recognition practices can materially affect reported profitability and financial position. While legitimate business reasons may justify accounting changes, unexplained or opportunistic adjustments may indicate earnings management. Analysts review disclosures carefully to evaluate whether changes improve transparency or simply enhance short-term reported performance. Aggressive assumptions regarding asset impairments, bad debt allowances, or pension obligations may overstate assets and earnings. The program emphasizes that accounting estimates involve management judgment, making them especially vulnerable to manipulation when companies face pressure to meet earnings expectations or financial targets. Non-recurring items and unusual transactions are another area requiring close attention. Companies may classify recurring operating expenses as special or non-recurring to present stronger adjusted earnings figures. Large restructuring charges, asset sale gains, goodwill impairments, or acquisition-related adjustments can significantly affect profitability and comparability across periods. Analysts evaluate whether these items are genuinely unusual or part of recurring operational patterns. Repeated one-time charges over multiple years may indicate poor operational performance rather than isolated events. Additionally, complex related-party transactions, off-balance sheet arrangements, or unusually large end-of-period transactions may obscure financial risk and distort reported results. Careful examination of disclosures and footnotes helps analysts identify these warning signs more effectively. Balance sheet trends may also reveal potential financial reporting issues. Rapid growth in receivables relative to sales may indicate slowing collections or aggressive credit policies, while excessive inventory accumulation may suggest weakening demand or overproduction. Declining asset turnover, unusual increases in capitalized expenses, or large deferred tax assets may further signal potential concerns regarding profitability sustainability or future cash flow realization. Analysts also monitor leverage trends, liquidity ratios, and working capital changes to identify signs of financial stress. Weak balance sheet quality combined with aggressive earnings growth often increases the likelihood of lower quality reporting. Comparing financial statement relationships over time and against industry peers helps analysts identify inconsistencies requiring additional investigation. Recognizing warning signs is essential for evaluating reporting quality, earnings sustainability, and long-term financial health. Analysts integrate quantitative analysis with qualitative assessment of management incentives, governance structures, accounting policies, and disclosure transparency to determine whether financial statements provide a reliable representation of economic performance. Warning signs do not always indicate fraud, but they highlight areas where additional skepticism and analysis are necessary. Transparent disclosures, strong operating cash flow, consistent accounting policies, and reasonable estimates generally support higher quality reporting. A strong understanding of financial reporting warning signs enables analysts to identify potential risks early, avoid misleading valuations, and make more informed investment, lending, and credit decisions within increasingly complex global financial markets.